The Taiwanese index is up 136 points. We have Hang Seng higher by 150 points.
SEBI has reached out to as many as 11 overseas regulators.
Strong bull momentum. That's basically what we have, and new highs are in sight.
Second time it has been cut to zero since the time it was levied back in July 2022.
It gives us a high amount of confidence that we'll see the momentum that we saw in this quarter.
But here's the first take on the index. Just consolidating its gains, really. So the Nifty at the 18,400 mark.
We've had some hiccups in March or so, and I think thanks to the Adani thing. Also, India had outperformed globally a lot. So things are getting repaired globally.
Financial year, we estimate it to be 7.5 rupees to 8 rupees per SCM.
Now the focus on scripts and movies is much more than before.
The mid-cap index is up nearly 1%. Very strong advanced decline ratio. We've got nearly 1,900 stocks gaining in trade.
Ultimately, we should worry whether we are importing too much more than what we are exporting.
Today, we are about 66% B2C company. Clearly, three distinct verticals.
They speak about redevelopment being the way forward for the Mumbai real estate developers. Quite choppy right now. We've fallen from the highs and right now down 34 points on the Nifty.
Well, that was a day so far. A quick recap. You're with us here on a fresh new edition of Closing Bell. We're coming to you from the CNBC-TV18 Motilal studios. I'm Prashant. With me, my colleague Rima Surabhi will join us shortly. And Nigel, of course, is joining us from the newsroom floor. Guys, hi. Good afternoon. I mean, I think a little bit more in terms of weight, Nigel and Rima, right? For the highs to come, it's always the anticlimax because yesterday it was looking good. It was looking up and up. The market did correct in the last 30 minutes. Some hesitation right at the top, and today it's seeing a bit more of that pullback extend. But it's not much; it's 1/3% or so. The Bank Nifty is flat. I mean, that also was lower, but it's come up. It's absolutely, no change really. If you look at stocks which are moving things, right, it's Reliance, which is adding about 20 index point pressure, and then say HDFC Twins, which are acting up. Broader markets, well, no such problems. They're doing better, much better. Look at the mid-cap index, the small-cap index, advanced decline ratio is positive. And it's a very rich field if you want to look at what is doing well. And on volumes, it's a long list of stocks once again. So that is the part of the market which has come alive, really. Now, two levels, one on the Nifty Bank and one on the Nifty. For the Nifty Bank, the 20-day moving average as of yesterday's close stands at 42,980. That is, of course, the support which comes in. The targets, of course, are new highs for the Nifty Bank, which is 44,151.8. We got to 0.7 yesterday, remember. And support for the Nifty is at the lower end of the rising channel, which also moves up. As the channel moves up, that stands at about 18,296, 18,300 roughly, about 45, 46 points from here. You don't want to close below these levels. Maybe we do do those highs and then do whatever else you want to do. You don't want to keep waiting and hanging around for that to happen. Rima.
Hi, but in a way, the weakness, at least on the Nifty and the sensex, is a bit technical because of HDFC Bank as well as HDFC Limited. So if you pull up the contribution plate, you will see that a 45-point decline on the Nifty is purely on account of HDFC Bank and HDFC Limited going ex-dividend, and the Nifty per se is down 47 points, out of which 45, 46 points is explained on the back of HDFC Limited as well as HDFC Bank. So stripped of that, the markets would have been on the flatter side. Mid-caps have come alive, as Prashant said, and they have been outperforming for the last couple of days. Pull up the week-to-date, month-to-date, and this is the outperformance the mid-caps have clocked in vis-a-vis the frontliners. The Nifty Bank right now, at least, is trading absolutely flat. Today is the Fin-Nifty expiry, so watch out for moves in the last 30 minutes. Defense stocks are surging. So Mazgaon Docks, Cochin Shipyard, Hindustan Aeronautics, across the board, big gains. And so many mid-caps are reacting to numbers or news flow, like Vesuvius. Good numbers, stock locked in an upper circuit of 20%. Astral is up nearly 6 to 7%. Repro India, after Madhukela bought nearly 5 lakh shares yesterday, is seeing another 16% up move. And yesterday as well, the stock was up close to about 20%. So it's just piling on gains in the broader market. Surabhi, hi. Welcome.
Hi, folks. Good afternoon. Joining a little bit late because we're just finishing up our digital offering. Prashant, I guess that's what it is, right? I was speaking to a technical analyst right now. And I guess everybody's watching, holding their breath around this 19,000 mark, this 18,887. The sense that I got from a lot of people was that if you take it out, and if you sort of take it out with some conviction, then the real euphoria and the big gush of retail money will really pile in. But as you're saying, for the timing, I think mid-caps are still celebrating, though the index is off the highest points of the day. Not just the Nifty, but even the mid-cap index is off the highest points of the day. But we still have a fair amount of traction in the form of some of these result reactions. There are other stocks as well, Lemon Tree, Aurobindo Pharma, Indian Hotels. So there are lots of ideas that are still floating about. Just pull up Bank of Baroda as well. One big earning out of the way. Of course, we'll hear from Bharti Airtel, but that will be post-market hours. But BOB numbers as well, not much of a disappointment, nothing much to complain about. So par for the course. So slow and steady, but laced with a little bit of caution, Nigel, which I guess isn't such a bad thing.
Well, that's right. So it'll be just a couple of points on the Nifty 50 as well as on the IT index. There was a positive rub-off from the Nasdaq overnight. And the Nifty IT index, well, the last time I checked, it was still in the green. So that's holding one end up, which is good. As Rima mentioned, the Nifty Bank is under pressure because of the technical factor. But on the Nifty 50 itself, earlier today we had put up this level, that 18,330. That is the support level, 18,300, 18,330. Today's low is around 18,327. So from those levels, we have bounced close on 20 points. Let's see whether or not we can hold on to that, because that's the crucial range. The options data is telling you 18,300, 18,330. But as Rima mentioned, today is the Nifty Financial Services Index weekly expiry. So that seems to be a bit of a swing factor. On the call writing side, we are seeing writing at around 19,550 call and 19,600 call. Now, this is important because this contract expires in the next 55 minutes. On the put writing side as well, there is some writing at around 19,450 to around 19,500 put. So going by this options data, and given that we are seeing writing at around the 19,450 put, the near-term support comes in at around 19,425. That's the positioning for the final 55 minutes. On the upside, yesterday we went to around 19,630, and from there we did a bit of a U-turn. So that becomes a bit of a resistance zone on the upside, given that we are seeing aggressive writing at around the 19,600 call. So that's the broad band out there, 200-point range between the up and the downside, going by the options data. If we can break beyond these levels, then maybe we'll see a bit of a fill-up on either which direction. Otherwise, that's what the positioning is as of now.
Okay, thank you for that. Let's tell our viewers what's lined up in the next 1 hour on Closing Bell. Bank of Baroda, IOC, Astral, all higher in trade on the back of the Q4 numbers. Complete earnings, fine print coming up.
We track market technicals with Jay Bala of Cash the Chaos and get his call on various indices, local and global.
Our Alpha Manager for the day, Anand Shah of ICICI Pru AMC, will be joining in to discuss his stock portfolio bets. All this and much more in the next 60 minutes.
Okay, well, how should you position yourself in the next 60 minutes of trade? That's the question. Mitesh is with us to answer that. Mitesh, hi, afternoon. Full 60 points now lower on the Nifty. What would you do? Would you buy this dip right away or wait?
Not yet, Prashant. Not because of anything else, but I think there's some lack of clarity on my understanding that, the breakout that happened yesterday, as you were just highlighting, I think at the beginning of the show, it was looking like the Bank Nifty will immediately go to new highs, and that should see the momentum spill over to the Nifty as well. Having seen the Bank Nifty take a mild breather and at an all-time high, I think, then a breather can extend to about a few days of consolidation as well. So keeping that in mind, either the Bank Nifty starts making a new high and then we go and buy it. Otherwise, wait for this whatever sideways choppy movement to play out and see if there's some more dip happening, and then try to buy it closer to the averages on the hourly and the 2-hourly chart, which is the 10-20 day averages or 10-20 period averages on the 2-hourly charts. So I think we'll just slightly wait and watch more. But the breadth is interesting. I think that point was also made. And that's where I think, we are looking for long opportunities. I have a buy on Exide, which after a few days of consolidation is picking up steam again. So here, recommending a buy with a stop at 192 or just below it for targets of 205. And the other stock which I like is Gujarat Gas. That's a buy as well. Keep a stop below levels of 480 and a target of 510 can be looked at.
Okay, thank you very much for that. Let's talk about Bank of Baroda surging in trade on the back of a good set of numbers. NII growth 34%, profit beat, improvement in asset quality. Abhishek is here with the fine print. Abhishek.
Well, Rima, Bank of Baroda has reported the highest ever return ratios in last 8 years or even more. The ROA at 1.34% and ROE at 24.8% are perhaps one of the best that you are seeing in last 8 years or more. So gross NPA ratio has come down to 3.79%, net NPA ratio below 0.9%. They are also one of the best that you are seeing in last 8 years or even more. Net interest margin, as you said, has been one of the highlights of the result. It's improved to about 3.53%, which is the best in last 32 quarters. Ex of Treasury, the core operating profit growth is about 27.3% YOY and about 9.7% sequentially, which is on the healthier, on the strong side. So slippages have come in at just 1.13% as annualized slippage ratio, and it's below previous quarters numbers. Analysts like Kotak Securities were working with a higher slippage number of around 3,800 crores. Write-offs, they continue to remain elevated for fourth quarter in a row. Annualized credit cost is at just 0.13%, which is one of the lowest that you are seeing in the entire banking sector. So the book continues to grow at lower risk. RWA to advances, that has declined to about 71.9% in this quarter when compared to 73.8% in the previous quarter, and domestic loan growth of about 16.3% YOY is perhaps the best that you are seeing in last 14 quarters. So in terms of PNL, both the ANA and PAT is ahead of our poll. Back to you.
Okay, got that, Abhishek. Thanks very much. Hard to find fault with those BOB numbers. Stock is up and away. Dipan Mehta joining us. He's, of course, director at Elixir Equities. Dipan, good afternoon. Always great having you on the show. So first off the block, obviously, BOB. I mean, the question is, I'm not going to ask you about the Q4 numbers. As Abhishek mentioned, I think there's not much to complain. Now, this stock is at a dream run, right? 80-90% in the last 1 year. The question is, if someone has, an incremental 100 rupees to invest in, should it go in an ICICI bank or say an HDFC bank, or should it go in something like a BOB?
Good afternoon, Surbhi, and thank you for having me on your show. I have a slightly different answer. So if you have an incremental 100 rupees, you need to see how much of that of your existing portfolio is in banks. Because you cannot be excessively overweight. Up to 35-40% weightage in banks in your portfolio is fine. And if that 100 rupees has to be invested in the banks, then I would still like to go with Axis or ICICI Bank, where I think the risk-return ratio certainly favors you. I know that the PSU banks have done exceptionally well, but going forward, sustenance is a big question mark. And these are absolute blue sky scenarios for the banking sector. But at some point of time, I think challenges will emerge, be it on raising resources. Maybe the NPA cycle can also turn. The segment itself can get very competitive, very technology-oriented. And end of the day, the PSU banks are at a disadvantage compared to a lot of the new generation fintechs or even the private sector banks. So from a fundamental perspective, I would like to go with the larger private sector banks. But yes, there's a trading rally happening in PSU banks, which you cannot avoid.
All right. Hi, Dipan. Good afternoon. Dipan, the ITD cementation stock is something that you have been tracking. I recall you were bullish on it. I had done a long interview as well, and you were quite cued into that. The stock saw correction, actually. When this entire Adani fiasco broke out, I think there was some doubt whether or not their order book is at risk. But at around 140 rupees, it's seen a good recovery from the lows. What's your view on the stock?
Yeah, Nigel, good afternoon, and thanks for remembering our discussion on ITD cementation. So already a disclosure needs to be made over here that we are invested in the stock and our views may be biased. You see, when you look at the entire spectrum of engineering construction companies, one of the top requirements or the top of the list is the corporate governance standards. And I think you can't find fault with ITD cementation. They have been a very conservative management at a time when a lot of the engineering construction companies are going in and investing their capital into infrastructure projects just to get the orders. ITD cementation stayed away from all of those strategies, and it has paid them off very well. It's a very well-managed company. You compare it with its peer group, it would have relatively higher return ratios, good quality balance sheet, debtors well under control. And we are seeing a fabulous bull market taking place in infrastructure, especially companies engage in infrastructure construction, and that's why ITD cementation does come in. It had such setback regards Kolkata Metro, but now that's well behind them. And valuation may be slightly on the higher side, but looking at the order book position and the earning visibility, quality of management, quality of the parentage, we would rate it amongst the best stocks to invest in within the infra or the engineering construction space.
Deepan, do stay on. Got more questions, but need to get into a mandatory break. On the other side, we'll also invite Anand Shah of ICICI Pru AMC. Stay tuned. Welcome back. Let's talk about some more stocks. IOC has surged in trade after the company released its Q4 numbers. Sonal is here with the details. Sonal.
Thank you so much for that. Well, it was a good set. Like HPCL, it was again a beat on all parameters as far as IOC is concerned. Their net profit came at 10,058 crore rupees, which compares with a poll of 6,393 crore rupees. Now, do remember, Q3 was extremely weak across refining and their petchem segment, and that has recovered this time around. So that is a good news. Their revenues are higher than the poll at 2.02 lakh crore rupees. EBITDA also a beat at 15,339 crore rupees. It is again a refining-led beat for the company. We'll talk about that in greater detail. Margins came at 7.6% versus a CNBC-TV18 poll of 6.5%. Now, refining-led beat because the reported GRMs came at $16 per barrel versus an expectation of $12.7 per barrel. Today as well, Nomura's report suggested how marketing margins are improving, and FY24 will see above normal marketing margins for all the oil marketing companies. Talking about their petchem segment, that's where their revenues doubled on a quarter-on-quarter basis. In fact, it has returned to profitability after a quarter where they saw massive losses of 600 crore rupees, also indicating that there's a recovery in petchem spreads as well. So it's a beat on all parameters, refining, marketing. We need to know the numbers here. But yes, looks like marketing side will also do well. So yes, it's a good set from Indian Oil this time around.
Okay, Sonal got that. That explains the euphoria on the stock, 3.5–4% higher on IOC. As those margins have surged ahead. But Sonal, also tell us about Astral in terms of mid-cap earnings. That's been the key mover, strong operational performance. What worked for the company?
Well, margins above 20%, that definitely worked for Astral this time around. Even the revenue growth wasn't bad, 8%, but volumes were higher. So the company did an EBITDA growth of 36% this time around. Margins, as I said, 20.8%, above that 20% mark versus 16.6% on a YY basis, leading to a profit growth of 38%. And it was not only led by their plumbing business. Across all the segments, they did well operationally. Their plumbing revenues were up 3.5%. EBITDA was up at 256 crore rupees in their plumbing segment, and margins, they surged by 600 basis points in this particular segment. The paints and adhesives segments, that also did well, where revenue growth came in at 25%. Their EBITDA was up 42%. On operating profit margins came in at 15.1%. Going forward, the management said that they expect margins to be between 17 to 18%, and this operational beat did not come because of inventory gains, but came because of economies of scale, and also because they focus more on value-added products. In terms of volume growth as well, in their plumbing business, they expect volume growth between 15 to 20% this time around, and they are also looking at expansion and capex plans as well. So commentary was strong as well because they say demand is intact. All these things working well for the company this time.
Thank you very much for that, Sonal. Deepan, any thoughts on Astral? It's a quasi-real estate play. Real estate companies are doing well, and so are all the companies associated with it, allied ones. In that, how does Astral stack up?
Yeah, just another disclosure that we and our clients are invested in Astral. I think it's amongst the best-in-class building material company. I would rate it at par with Asian Paints. And unlike Asian Paints, it has gone from category to category and really made successful businesses out of it, done very intelligent acquisitions like when it entered into the plastic water tank business as well. They are trying to become a complete bathroom solutions company, and we can see that transformation underway. So I think it checks all the boxes when it comes to a good investment. The only thing you have to compromise on, of course, is the valuation. It is very richly valued in a price to earnings multiple basis. But it's a secular long-term story. Maybe not today, but on the days when it is slightly weaker on corrections, one could look at getting into Astral. And I think as and when more opportunities open up in the building material space, this is one company which has got a very aggressive agenda, which they will pursue it. And they've got a strong balance sheet and good management capabilities as well to keep in mind.
Okay, Deepan, thank you very much. Good speaking with you. Appreciate you joining in with a lot of that perspective. It's always good speaking with you. Well, Anand Shah is now joining us. He's Head Portfolio Management Services and Alternate Investment Funds at ICICI Prudential Asset Management Company. He's joining us now on the program. Anand, good to have you with us here. Thank you very much. I have the data from PMS Bazaar, which ranks, PMS schemes and alternate funds, etc. And I think this is data till the end of December 2022. Congratulations. I mean, across large cap, multi cap, mid cap, small cap categories, ICICI Pru has done very well over a 3-year CAGR basis. The numbers look quite good. So congratulations to you and your team.
Thank you.
What from here? I want to just start with mid caps and small caps, Anand, because that is also something that you spend a lot of time and energy on, finding the next winners. Are we at the not the cusp, but are we in the midst of a broad up move for the mid and small cap part of the market, which is going to last for which will be with us for some time? And what are the tailwinds, drivers really for this space from here out? Go on.
Yeah, hi, very good afternoon. So yeah, if you were to just step back, and we've been talking about manufacturing for a while, so in my all the previous our interactions, we have spoke about it. So a lot of credit to the team. We've been able to capture many turnaround stories within manufacturing early on in our strategies, and that's been sort of helping on the fund performance. Coming to mid and small cap, to be very honest, a lot of manufacturing allied businesses, which are generally the ancillary businesses to the large businesses, have been struggling for a while. And no wonder mid and small caps actually had a very difficult time. And that reflected in the NPAs in banks also to some extent among the smaller companies. I think that's all behind us. We believe the environment generally in the economy has improved. The profitability is more now wider, in the sense large segments of the market, more sectors in the market, more companies in the market is contributing to the overall profitability of India Inc., which in turn then reflects into the turnaround in the mid and small companies. So I think if I were to summarize, yes, manufacturing is looking up, and a lot of mid and small cap actually operates in that segment of the market. So we remain quite sanguine. We've been continuously evaluating businesses in both financial services side as well as within the manufacturing allied for our portfolios. And we like the earnings growth very much, but even the valuations are fairly attractive in that segment.
All right. Hi, Anand. Good afternoon. Nigel on this side. I'm looking at your Contra fund, your Flexi fund, and your other one as well. You seem to be having some exposure to metals, both the large cap names as well as some of those mid-sized companies. What's your view? Because on a day-to-day basis, actually, the Chinese data is looking a little bit disappointing. This morning as well, we got some Chinese data which is a little bit disappointing. So how would you approach this space? There is some weakness that we are seeing on ground in terms of prices. Particularly on ferrous, how would you place yourself?
Yeah, indeed, Nigel. I think what is happening is while the structural story within the metals is improving, as I've been saying consistently, that the cost of producing ferrous metals in China and even in other developed nations like US, Europe, Japan, Korea would continuously go up as they embark upon decarbonizing the steel manufacturing in those countries. So I think that's the structural part of the story. Having said that, that's not worked in last 1.5 years. We had a severe lockdown in China, which obviously took away a lot of real estate demand in the steel segment, and to that extent there has been a slowdown there. Obviously China reopened and they have been sort of producing a lot. Having said that, we still see, as you rightly said, we still see weakness in the data in China, and as much as in terms of real estate, and to that extent on the steel side. But I think still, I continue to maintain that as China becomes more prosperous, you would see that they will embark more and more in decarbonization of their economy, which includes steel. And that means that structurally the steel prices will remain more constructive. When we come to India, I think companies had a very difficult time. In last decade, they were leveraged. Obviously, the competitiveness was very low. All that has changed. Many companies have fixed their balance sheets, they've fixed their debt. And to that extent, I think both top down and bottom up, many of these businesses are today more stronger on balance sheet, more capable of withstanding the lower metal prices today than they were a decade.
Okay, all right, got that, Anand. Good afternoon. Just looking at, your portfolios across different schemes, industrial giant like L&T manages to, of course, find a mention here and there in several of the portfolios. And you have smaller companies as well from the automotive space or niche manufacturing space. What's the thesis that you are going with? And this is a very large, segment otherwise. So what's the specific bent of mind with which you're approaching, whether you call it capital goods or you call it, heavy industry or engineering? What kind of companies make the cut for you?
No, so I think if you see since global financial crisis, I think there has not been a great capex, and both private sector, or in particular, was sort of couldn't revive from that crisis. Obviously, we had a lot of investments then. I think that's changing slowly and steadily. Government capex leads in terms of the intensity with which and the growth that we are seeing in government capex. More importantly, if you recall 2019, we gave a lower income tax rate for the new capex. We have seen PLI, Atmanirbhar. So I think somewhere import substitution is also something which is important. On top of it, you have heard this time and again of late, China plus one, Europe plus one. So again, there is a need for an alternative manufacturing location, and India is emerging as one of those countries where you have capacity, capability, and also intent. So I think when I see so many factors coming together, my take is, India has lost a lot in terms of manufacturing. Manufacturing as a percent of GDP has really fallen off. We had become a lot, or we are today a lot services oriented. IT services and financial services form a large part. But I think manufacturing is important if we have to employ such a large population that we have, and we can't be importing and consuming, goods. I think in that sense, if I were to just summarize, real estate drives one segment of the capex which is doing very well. We've heard that from many market participants. Government capex is doing well. I think what we are waiting for is a private sector capex. Again, the ingredients are there. Last 2 years, we have seen deleveraging within the corporate India, but also the balance sheets of banks have strengthened a lot. So the banks have capability to fund the private sector capex. Private sector capex balance sheet has today ability to borrow from the banks. And now if the demand, which sort of got pushed back by a year because of the global energy prices and global slowdown and destocking, I think sooner than later, but I think somewhere the private sector capex should also start contributing to the overall positivity that we've been seeing in manufacturing and manufacturing allied, like cap goods, industrial products, and construction companies.
But Anand, this manufacturing is now no longer, it's a fairly discovered sector, discovered theme. A lot of people have been talking about it for the last 12 to 18 months. Stocks have done well. The order book has been expanding. The companies have been reporting good numbers, and valuations too have soared. Do the valuations of these companies make you a bit wary and cautious? Are you okay to invest at current levels?
Indeed, I think some of the companies have got re-rated, but in the same breath, let me also tell you, some of the companies have actually underperformed their earnings growth rate. So, yeah, there are two elements. One is the quality element within this. Some of those cap good companies, the ones which have technology edge and others, have got re-rated. But many are low end of manufacturing, the commodity manufacturing space. There actually the companies have done much better, but they've got derated. So it's a mixed bag. Overall, even today when I see my portfolios, or we see as an entity, the manufacturing allied, even today it would be trading at a discount to the overall, the valuations that market trades at. Even today we have a significant premium in the consumer-facing businesses, while their earnings have been sort of growing slower than this area, but they have a significantly high return on equity, which in turn today unfortunately is attracting more competition, but that's the case, and that's why they are trading at a much higher PE multiple.
Okay, got that. Anand, so before we let you go, I mean, a broader question on the overall mood, the texture and the nature of the market and market participants. What do you make of things? I mean, a long 18-month wait to get back to these near all-time high levels. What's the sentiment like? Do you think the market is ripe for a real breakout and a meaningful up move above the, say, 19,000 mark? And if indeed that happens, then where do you think the next leg will come in from? Will it be more mid-cap, small-cap, micro-cap led? What themes might, say, outperform over the next 6 months as we get to the end of the year?
No, indeed, it's been a long 18 months. I agree with you. But I think a lot of internals have changed within the earnings also. If I see a total breakup of earnings of the India Inc., I think banks have significantly raised ahead. So banks now form a significant part of the overall profitability of the India Inc. So that's one. What we have also seen is a significant de-rating in a very expensive consumer-facing businesses, while some bit of re-rating in manufacturing. I think they're still apart, but that's also something that has happened in the last 18 months. More importantly, we saw one round of funding available to the startups, which have a lot of growth, but very little profitability. I think there also the sentiments have changed. People are asking for profits at this point of time. So while the market is going back to where it started off 18 months back, but I think internally a lot has changed. Coming to outlook, I think, as I said before, the breadth of the profitability is significantly improved. More number of companies are doing better than less, which was not the case pre-COVID, if you recall, where a very small set of businesses to drive the overall profitability. Today, it's fairly wide, and to that extent, more number of companies are doing better than was as we speak. So that's one significant ingredient. Within that, again, both manufacturing, consumer-facing businesses, banks, everybody is, if you are well behaved and if your balance sheet is strong, if the business models are right, I think there is a right to win. So that's another element. So overall, the alpha creation has been much better in last few years than it was before. So the stock picking opportunities are much more. Similarly, mid and small cap again offers you much more stock picking opportunity as we speak, and that's where the alpha is also being generated for many of our domestic mutual funds and PMSs. Coming to lead the earnings growth, I think banks are clearly leading at this point of time in terms of the quality of balance sheet as well as quality of earnings.
All right, Anand, always good hearing your thoughts. Thanks so much for joining in and filling us in with your view on a whole host of sectors. By the way, the markets have moved to the low point of the day, and I think a couple of large cap names have moved lower. Reliance Industries, pull up the intraday chart out there. ITC, well, there was some speculation or some unconfirmed reports that maybe there's a price increase, but that stock has moved to the low point of the day. Just take a look at that. Saw a bit of an uptake, but that got sold into. And Tata Motors, that's the third one in there. So Reliance, ITC, as well as Tata Motors, all of them have seen a bit of a downtake, and that explains why now we're closer to the lower point of the day. But a good time to move to our special segment, D Street Chatter. All right, I think we have Prashant with us. Prashant wants
Nigel,
to make a
the news at the bottom of the screen, Nigel. I don't know. How do you feel about from the 3rd of July? We'll in the morning. We'll not say SGX Nifty. We'll say Gift Nifty. So I just wanted to point that out for our viewers. This is, of course, I mean, it's been one of the most closely tracked way to, in a way, get a sense of how the sentiment is. For India before markets start to trade. And the flash at the bottom of the screen, in that sense, this is coming from the NSE. So from the 3rd of July 2023, all orders which come to the Singapore exchange, they'll be transferred to the Gift City IFSC exchange here in Gujarat, and they'll be matched here. All the orders will be matched here, and a notification to this effect came through in April, and now all the approvals are in place, and this is going through. So, bye-bye SGX Nifty, and welcome GIFT Nifty in that sense. So that's what's happening.
All right, got that.
I think most of us would remember this is something that started 4 or 5 years back.
Yes.
It was a bitter arbitration between the NSE and the Singapore exchanges. Then, of course, there was some sort of a truce on this. And finally, IFSC has emerged as a big center. And this is not a small index or a small contract. This is, as you said, is a barometer of market sentiment here in India.
Absolutely. All right. Well, that's GIFT Nifty for you. Nigel, back to you. The chatter.
Yeah, let's. Nimish is waiting by as well. Nimish, tell us how you're reading today's, flows and the data points as well. It appears we're at the low point of the day. There's a technical factor as well because of the HDFC.
Well, technical factors and some bit of profit booking as well, right? We've seen a big up move in the last many days. The good part is today, the downside is led by some institutional activity picking up as well. So the volumes are on the higher side, the participation is on the higher side. Within sectors, I believe there are good flows in banks and FMCG. Within banks, it's the private banks which is seeing continuous buy flows. So that's the one sector which is well bid. The other sector which deserves a mention is the IT names. Some selective buying is back within the large IT names as well. That's the overall feedback as far as flows are concerned. But I guess the big trigger to watch will be the PSU Bank Index on the back of numbers from Bob and SBI. Both will report numbers. Apart from numbers, I guess SBI's call on the ELC will be a big trigger for the entire PSU Bank Index. Remember, that's one sector which has underperformed, and there are a lot of fears as well. So I guess for SBI, the street is expecting strong numbers, but the clarity on ELC could be a big trigger for the PSU banks to resume their upward again after the recent underperformance. So that's the overall feedback. But largely a day of consolidation, but the activity is picked up. So two ways to read into it, that on the downside, the volumes on the higher side, but there is participation for sure from the larger institutions in today's trade.
Well, indeed, that point on the PSU banking names, last 10 days have been the biggest underperformers, though they've had a great run in the last 1.5 years or so. But Nimish, tell us about individual stocks. What are you picking up?
So in terms of individual names, the first stock on my list today is Indian Hotels. This is one stock up in today's trade. Largely, it looks like some bit of buying is resumed. There was a bit of a correction or some bit of profit booking after the results season. That seems to be over now, and the FI buying seems to be back in Indian Hotels. So that's the first one. The second stock is Devyani International. Again, this is one stock buzzing off late. Some bit of activity is picked up. The volumes are on the high side, and I believe one of the long-only fund has turned an active buyer in Devyani International. So that's the second one. The third stock is Max Healthcare. This stock saw a big move post the MSCI inclusion, and there is a large buying as well on the day of the adjustment on 31st of May. But before that, watch out for a large block deal. That's the overall indication that there could be a large block in Max Healthcare very soon. So that's the third one. And the last stock is IEX. This stock is actually buzzing in trade. In fact, it's up on good volume in today's trade, but I believe there are strong sell flows at a leading FI. So it looks like some bit of uptick in today's move has been used to sell a large position by a larger FI. So IEX, though the stock is up, but there is selling pressure from a larger FI.
Nimesh, interesting list as always. Thank you very much for that. Get into a break. On the other side, we'll get you a few technical trading calls, BTST, from our expert Nitesh.
Welcome back. You're tuned into Closing Bell, and we are coming to you live from the CNBC-TV18 Motilal Oswal newsroom. Well, life insurance data for the month of April is out, and no one better than Yash to join us to analyze those numbers for us. Well, Yash, LIC, the numbers continue to disappoint, I think.
Well, absolutely. Second straight month of disappointment when it comes to LIC's numbers. But in totality, the flavor for the month has been weak, and that's because a large part of insurance buying got advanced to the month of March because of the taxation rules. So as far as the industry is concerned, the April premium is down 30% on a year-on-year basis. On a month-on-month basis, it's down even further, up to 76%. Private life insurance industry, that because of two players, the premium has grown by 9%. On a year-on-year basis, it's down 71% on a month-on-month basis. Now, speaking about the biggest loser, that is LIC. The April premium, when seen on a year-on-year basis, is down 50%. On a month-on-month basis, is down 80%. April retail APE is also down 5% for LIC. HDFC Life, decent numbers out of the lot. So So April premium has grown by 3% on a year-on-year basis, still down 74% on a month-on-month basis, and retail AP, that has also grown by 7%. ICICI Prudential Life, again, weak numbers. April premium down 17% on a year-on-year basis. On a month-on-month basis, down 74%. April retail AP also down 31%. Max Life Insurance, on a year-on-year basis, the premium growth is flat. On a month-on-month basis, it's down 82%. April retail AP is also down about 4%. Finally, SBI Life Insurance, again, the premium has managed to show some growth. April premium is up 8% on a year-on-year basis. On a month-on-month basis, it's still down 62%. Retail AP for SBI Life is down 5%. So simply, there are just two companies which have grown their premium on a year-on-year basis, that is HDFC Life and SBI Life. But HDFC Life has also managed to grow its retail AP when seen on a year-on-year basis.
Okay, well, thanks very much, Yash, for that. That's life insurance data, which has come in finally. I mean, usually used to come in the first week, a little after the first week, but now we're getting it later and later. Mitesh is joining in to run us through what to buy or sell today for a reverse trade tomorrow. Mitesh, the cuts deepened a little bit more. What would you do?
So as I said, Prashant, I think avoid the index, focus on the breadth. Though I think the breadth, with the last few minutes has also slightly tapered off. My worry would start if we see the Nifty start getting below levels of 18,240. Then I think, we are not looking at only a consolidation, but maybe a slightly deeper pullback led by profit booking. So having said that, I think, on the stock side, HDFC Bank is something, which is really turning negative, and that's an STBT with a stop at 1655 for targets of 1625, while Indus Tower remains strong. So that's a BTST with a stop at 152 for targets of 158.
Okay, thank you very much for that. Let's shift our attention then to the earnings corner. Let's tell you what the key earnings are to track for today and the rest of the week. The big ones today will be Bharti Airtel, typically comes out between 4-4:30. JSPL also should be on your radar. Tomorrow, 17th of May, Jubilant FoodWorks, Thermax will be reporting their numbers. 18th of May, a few companies will be reporting their quarterly numbers. They include GAIL, Bata, Interglobe Aviation, ITC, State Bank of India. Big day. And on Friday, JSW Steel, Zomato will be reporting the Q4 numbers. So from tomorrow's list, the big one is going to be Jubilant FoodWorks. Mangalam is here with the expectations. Mangalam.
But it's a weak set which is expected from the pizza maker, and that's largely because of weaker consumer sentiment. At the same time, the company has rolled back some of the price hikes that they've taken and also gone ahead and increased their value offerings, which is the 50 rupee pizza, sub 100 rupee pizza as well. The stock's down about 30% from its 52-week high. We're expecting a revenue growth of around 9%. The street is working with a number around 1,250 crores on the top line. However, the EBITDA declines by about 10%, and the net profit as a result of which on a low base also declines by about 40%. We're looking at a number of 70 odd crores. Domino's is, of course, stopped giving the same store sales growth. Instead, they give the like-for-like growth, which is adjusted for store splits. So this time around, we're seeing a number anywhere between -3% to 2% in the positive. And the store count over the last year has increased by 15-16%. Despite that, the revenue grows just about 9%. So that's telling you there could be a higher chance of a negative like-for-like growth. We're expecting the company to add around 50 to 60 new Domino's stores. But apart from that, we'll watch out for any sort of commentary coming in on demand from the value products, cheese inflation, and more importantly, what they're doing with the Popeyes brand, where they are increasing outlets out there, and this could be the next engine for growth for the company.
All right, got that. So we'll watch out for Jubilant tomorrow. Mangalam, thanks very much for that. Well, the bulls certainly seem to have lost their appetite. Look at the market now, because we are looking at a whole 100-point cut, actually 112 points in the Nifty. That's a cut of about 0.6%, and blame it on the usual suspects. I mean, HDFC Bank, because of the dividend factor, they've been putting pressure right from the morning. That pressure continues. Add in a Reliance now. Reliance was sluggish in the first half of the day, but now it's decisively lower, 1.5% lower on Reliance. ITC, L&T are some of the other heavyweights that have helped the bears' cause today, not quite the bull side. There we go, days low on Reliance. That explains some of the additional pressure that we are seeing. Okay, so good time to bring in Jay Bala and get a view on the technicals. Jay Bala, of course, is from cashthechaos.com. Good to have you on the show as always, Jay. If I recall, I mean, the last conversation that we had, you had retained your cautious stance, and I think the overall view was that perhaps what we could be witnessing is some sort of a buying exhaustion in the market. I don't know if you still retain that view, But looking at the market just around this mark, we're what, 400 points away from all-time highs. What's the sense first on the Nifty and the phenomenal rally that we've already seen on the Bank Nifty? That index already made an all-time high.
Yeah, thanks for having me on the show, Surbhi. The markets are doing pretty much as anticipated. And it's just the fact that it's overshot the upside. I anticipated about 18,134, but the markets have shot up past that closer to 18,400. But it doesn't change things. In fact, if we have a close below 18,315 today, the markets have flipped to the bearish side. But since the markets have been slightly stronger than my anticipation, I would also like to see the market take out 18,055. Even 18,190 will be a signal that the market is going to take out 18,055. But once we have this confirmation from the market, we are possibly looking at a waterfall decline for the markets. And I've been maintaining that in the medium term, the markets need to go below the June 2022 low. When it comes to the Bank Nifty, I need to slightly, take 10 seconds to explain the medium to long term. If you look at the bank index from the pandemic lows, we define trends as a non-overlapping move when it comes to the pullbacks. But right from the pandemic low, all the pullbacks have overlapped into the previous highs. So this is a very, very critical signal from coming from the banking index. Even if I force look at the banking index as a trend from the pandemic low, the banking index from the April 21 low is choppy and overlapping. That's a very, very bearish signal. And if the banking index were to close below 43,313, I think we have a bearish flip for the banking index too. And the reason why I explained the medium term, it's going to correct either the entire move from the pandemic low or the move from the April 21 low. So that's the reason why you need to have a picture of the medium term view in the banking index.
What a waterfall decline right now in the banking names, particularly the Nifty Bank. Just in the last few minutes, it's lost 200 points. It was holding up in the green with a gain of about 100 points at one point of time. But just in the last, 10 minutes, it's down 200 points. Perhaps it's to do with the FinNifty expiry as well, because names like HDFC Bank, HDFC Limited are also selling off very sharply. The dividend on HDFC Bank was about 19 rupees, but the stock is down close to about 30 odd rupees. And even on HDFC Limited, I think the dividend was about 44 rupees, but the stock is down 65 rupees. Nigel?
No, that's right. I just wanted to point that out itself. The Nifty Financial Services Index, just take a look at that. That's broken that crucial mark of around 19,425. So it just about broke that mark. Not great news at all. And that's why we're seeing that the Nifty Bank as well as moved low. My guess is, we just pull up a couple of heavier names, whether it's Bajaj Finance or you could pull up HDFC, because that's not part of the Nifty Bank, but that could have moved a little bit lower as well. But let's continue our discussion with Jay. Hi, Jay. You're still sounding a little bit cautious. Since the Nifty Bank has moved to the low point of the day, what are the levels you're looking out there?
Yeah, it's important that, to assume that the banking index hasn't yet reversed as long as it stays above 42,500 on an intraday basis. As I said earlier, 43,313 close below that, and a break below 42,500 will signal the banking index has reversed. Until that point, it's okay to hold on with trailing stops. So those are the important levels for me on the banking index.
Right, Jess. Is there a pattern we can? So you go to, or you almost hit the all-time high. An index gets there, important index like a big Nifty Bank, and then there is a pullback, and then you get a day like today. Anything? Because the index has been in an uptrend. For all practical purposes, there was a 10 paisa miss yesterday. Is it just nervousness? How would you read it, historically speaking? Have you seen this kind of patterns before, and how does it play out? Just from that angle.
Yeah, I think you're referring to the banking index. That's what missed the all-time high by 10 paise. So, if you look at the banking index from the, lows of March or the lows of April of last year, as I said earlier, it's been chopping back and forth with all the pullbacks, touching the previous highs. This is an ending pattern or a corrective pattern. It's not a continuation pattern. So that's how we work out in technical analysis. And even if you slightly take a tangent to the US equity markets, people are thinking the US markets are resilient, but actually just 47% of the S&P 500 stocks are about 50-day moving average. And if you take out the big five, the S&P 495 is near its March lows. So, and the Dow Jones Transportation Index, which is pretty critical and a barometer of the economy, is also near the March lows, and the Russell is below the close to the March lows. So, the external look for global markets on the surface looks positive, but there are cracks in the most of the equity markets. And added to that, I'm very bearish on copper. We have discussed copper a few times here in February, March, and as well as a couple of weeks ago. Copper is set for a 26% decline. I don't care if it's saying it's a recession or anything. The price action is telling me there is a 26% decline ahead. I posted a chart of this on my handle in February. The copper commodity is behaving exactly as I've anticipated.
Okay, 26% potential decline in copper. Jay, do stay on. We've got a few more, stocks and sectors to discuss, like FMCG, capital goods. For now, we need to slip into a very short break.
Okay, welcome back. You're with us here on Closing Bell. Jay Bala, of course, is still with us. This, just counting down to the close 5 minutes, as I said. Jay, we discussed some of the indices here, but since if you referred to some of the global averages, S&P, just the large tech names holding up things and transports index there. What about the dollar and US yields, etc.? Are they they seem pretty well behaved for now? But you believe they're close to the bottom rather than the top?
That's right. The 10-year US 10-year yields and the dollar index is in a very similar kind of structure. They are signaling possibly a bottom, or there is one more low. That's the unclear picture. That's confirmation which hasn't come from either the US 10-year yields or the dollar index. If the dollar index were to take out 103.36, the spot dollar index, then it confirms a bottom is in place and a sizable rally, maybe even record highs, but we can take it as a counter trend rally to 100, 109, 110. So even that is signaling that. But if the yields is a surprising part. I don't know what's going to trigger higher yields, whether it's going to be higher inflation or the Fed is going to see the inflation as being sticky. I don't know what reason that's going to trigger, or it could even be the debt ceiling talks failing. Anything could trigger, but if the yields were to cross, 363, 364 bips, I think the next leg up for the US 10-year yields is underway, and it's going to be somewhere close to, slightly less than the 500 bips.
Okay, Jay, so quick final question. I was just looking at US indices, whether it's the Russell 2000 or the S&P 500. It's interesting. We are talking about breaking out of a 18-month consolidation, whereas some of these US indices actually have done nothing but consolidate. If you look at a slightly longer chart, I think you look at the Russell 2000 very carefully, if I'm not mistaken, that or whether it's the S&P 500. What is the critical level that you're tracking on any of these indices to offer further clues?
Yeah, see, since I trade the S&P futures, the 4063 on the S&P futures is very critical for me. If the S&P futures were to go below 4063, it marks start of the next leg of the decline. The consolidation would be over for me. And likewise, the transportation index is forming a head and shoulders pattern, which is a continuation pattern at the moment. If it were to break below the recent low that existed a couple of weeks ago, that will also signal the next leg down is over, and the consolidation has been a bearish consolidation. And the move has been very choppy for a lot of people who don't understand Elliott waves. Any move that's choppy and not which is overlapping is a correction, and it's all classic corrective move for all the US indices from the October low. None of it is trending up.
All right, Jay, thank you very much. We'll leave it there for now, but we'll have you back soon again. As we continue to track markets closely, we're going to end down 120 points on the Nifty. 18,278 is where we will around where we will stop today. So let me just quickly wrap out things and what happened today in terms of specific stocks. So HDFC Bank, of course, there was a technical factor. Reliance was adding pressure downwards, and then there was Kotak Bank and ITC. So between these 5 names, you can it's about 80% of the 120-point loss that you had in the index, maybe a little bit more by close. The old economy oil companies, BPCL, ONGC, Coal India, these are the names which actually ended higher. Market breadth suffered quite a bit by close. I think there is not very much by way of difference between gainers and losers. Actually, it's more down than up by close, by a small margin. But I have to say that the number of stocks which went up with volumes is a very long list as compared to, just looking at how many were down and how many were up. So numerically, more losers than gainers, but the momentum still very much in mid-caps, small caps on the upside. Surabhi.
Yes, Prashant, but I'd have to say that some of that momentum also started coming off towards the end because mid-cap index is going home with a gain of just about 0.25%. I mean, this index was roaring away with a 1% move in the morning, but a lot of caution creeping in this side of the market. Anyway, since it's up, we'll start with the winners. Some of the result reactions like Astral, Vesuvius, these are the high flyers of the day, 20% up on a Vesuvius. Decent gains on a Policy Bazaar. Some of the hotel stocks like Lemon Tree, Indian Hotels, not bad, 2 to 3% up on some of these as well. But then I have to add some of the areas where there was a lot of profit taking, some caution. And this includes the PSU basket. So whether you're looking at NFL from the fertilizer space, REC, PFC, quite a few of these names. Include some of the PSU banks as well, by the way, like a Bank of India, for instance, City Union Bank. So some of the others, not so much City Union, but of course, Bank of India is definitely a case in point, where the gains became a little more muted. NCC, these were some of the other names where there was some pressure. However, Bank of Baroda has had a pretty decent session for itself. The numbers were well received by the market. We'll just pull up the final tally here. At its peak, it was up about 2%. It's still going home with a gain of almost 2%. So good numbers, rewarded well by the market. Vodafone Idea, just a 7.5 rupees stock, but managed a bit of an uplift, an up move for itself. Hudco, 7%, Trident. So you do have, of course, the movers and shakers on the upside in the mid-cap market, but yes, a fair amount of caution definitely creeping through. But I guess, Prashant, we can't take away from the fall, the fact that the pace of the fall in the last 1 hour was definitely something that you can't ignore and look away from.
Yeah, no, absolutely. In the last, I think, 15-20 minutes, the Nifty Bank lost 150, 160 points. And I think Nifty, of course, was looking a little weaker earlier as well. So 18,273 on the Nifty. We've closed below the lower end of the rising channel, which is at 18,296. That's a level we highlighted at 2:30. By close at 3:30, an hour later, that was gone. All eyes on U.S. markets. Jay Bala, for example, was talking about that don't ignore U.S. It seems all calm on the surface, but there's a fair bit of pain under the surface, and it will emerge for the broader market there as well. U.S. retail sales data will be the big one to watch when we come back tomorrow. And of course, we'll pick up where we left off based on some of the global stuff we will get. It's a wrap on this edition of Closing Bell from all of us here. Thank you very much for watching. But don't go anywhere. Our Tuesday special, Commodity Champions, is coming right up.